we've raised some money, we've got some equity, now where do we invest? Predominantly we're looking to invest in the property market or the share market, or both. Okay, let's run through some share strategies where we can do some things there. Now, predominantly we're going to look at cash flow strategies, but there's also capital growth strategies in the share market. Then I'll give you a quick example of property market as well. So in shares, let's say you have XYZ share, and what you're going to do, first step with shares is to know when to buy a share, or what to buy, and what price to pay for it. So there's two forms of analysis. One is fundamental analysis. Okay, Warren Buffett, is he fundamental, yes or no? For those you don't know, Warren Buffett is a fundamental analyst. In other words, fundamentals are looking at the profit and loss of a company and looking at the long-term increase in its share price, what you expect by its increasing profit. Basically, the fundamentals of a business. The other form of analysis is technical analysis. So I'm not going to go into that because that's a whole seminar. But technical analysis is basically looking at the shorter-term charts and patterns, because shares will travel in patterns. Okay? And over a period of time, this might be over a month, or this case might be over 12 months. So you can start to track the minute patterns of a share, and based on that, traders can increase the odds of what they think the share price will do. Okay, because shares follow patterns. So that's technical analysis. You can use both forms of analysis. I'm more into fundamentals because I look just like Warren Buffett. If I want to buy shares, I look at one, he looks at, does he understand how the business makes money? Very simplistic, very common sense. But if he can't understand how it makes money, how can he understand where that business is going to grow? So he also assumes that he's treat the shares that you're buying as if you're buying the whole business. Now, some of you might say it's all right for Warren Buffett because usually he is buying the whole damn business. But as an investor, that's what you want to look at. Would you buy, whatever share you're buying, would you want to own the whole company? Would it be a good business to own? Now, if you can't figure out how it makes its money, then how are you going to have any idea of whether it's good business or not? The other thing he does is make sure they're making a profit. Wow. I mean, this is so common sense, but he's also a multi-billionaire. Do you know what I'm saying? People forget common sense often. So is it making a profit? Some businesses aren't profitable. Why would we buy them? Dot-com boom. Warren Buffett was criticized because he didn't go in and buy the dot-com companies. But his rule was, are they making a profit? No. Do I understand how they make their money? No. And that's because they weren't making money. No one understood how they made their money. And therefore, he valued fundamentals. I'm not buying these stocks. And he was criticized. But who had the last laugh? Dot-com disappeared. The only dot-com internet companies that are actually worthwhile investing in back then were the ones that had a good business model, i.e. Google, etc., eBay, because they were making money and you could understand how they were making their money, and there you can make a value judgment much better. Making sense? So that's a whole seminar you could do just on when to buy a share, etc. Let's say a share is at $16 and it's been trading up to $19. The other thing you can do, number 2, is a strategy called channeling. Now, this is a simplistic strategy top investors use, but if you start following a share, particular shares that you're interested in, over time you'll see they'll follow in patterns. So some shares might go over a period of 12 months, they might go up and down, as much as, say, 4 times as an example. So if you were to know this, you might buy the share here, next time it's at 16 and exit before it gets to 19. Let's say you made 20% on your money here, 20% a year. But if it's traveling in patterns that does that 3 or 4 times a year, let's say it did that 3 times a year, here and here, then you could have made, say, 60% on your money. Where an average investor doesn't even know what they're doing, has bought the share maybe at 19 and not 16, but let's say they bought it at 16, they haven't even watched the share price, they come back a year later to go, I better check how my shares are doing, and they're back down at 16. What do they think? Useless shares, gone nowhere. I've made no money. But if you were channeling, you go, great share. I've made 60%. I don't care there's back there now. Who's following what I'm saying here? So by extra strategy, extra knowledge, it increases our potential return. Number 3, what you can do is leverage. In other words, if you're into the market, you don't have to use all your own money. So you might be using some of the line of credit of equity out of your home or out of investment property. And then if you want to leverage it more, you can get what sort of a loan? Margin loan. There's one way you can do that, okay, with a margin loan. And generally, you're going to get a margin loan. What percentage lend should you go up to maximum? Generally, the rule is invest at 50-50. You put in 50% deposit, not like property where you might put in 10% deposit. You put in, say, 50% deposit, you can borrow 50%. You can actually borrow up to 70% on some shares. However, you've got to be careful with leverage. You increase your potential gains, but you also increase your potential risk. So the share price plummets, falls through the floor, you'll get a phone call called a margin what? A margin call, which is saying you need to put bigger deposit in because your deposit's been eroded because the share price has fallen. So you have to put the cash in within 24 hours, or they can sell your shares. And they sell the shares at the low price they've fallen to. That's how people lose money in the share market. So two things you can do against that. If you're leveraging in the share market, who thinks it might be a good idea to insure your shares? Raise your hand if you think that might be a good idea. Does everyone who always follow good ideas, though? Yes or no? No. Many people don't. However, do you insure your house? Yes or no? And you say, well, I've spent the last 20 years insuring my house and it hasn't burnt down yet. I've wasted my money. Or do you go, you know what? I've had peace of mind. Because that 1 year it does get burnt down, that insurance has been very worthwhile. That's attitude I'd suggest